Hi, in the previous video, we talked about the internal rate of return, which is the IRR here, and we have seen that the calculations for the IRR might not be very easy in many cases, especially when you have cash flows more than 2 years, which will result in a higher order polynomial, which cannot be solved by hand and is often done by Excel formula here. So are there any ways that we can sort of approximate the IRR here? Yes, there are. So the first method is that we can use trial and error. Let's just take a guess at the IRR here, because we can assume in most cases, the higher discount rate, the lower the NPV. So let's just take a guess at the discount rate and see if we have a positive or negative NPV here. If we have a positive NPV here, then we know the discount rate is too low. So we can increase that until the NPV is close to zero, and vice versa. If we have a very high discount rate, the NPV is likely to be negative, so we can decrease that high discount rate until the NPV is getting close to zero, and that specific discount rate is going to be very close to our IRR here. But that is going to take too much time, and a lot of calculations will be required. So we can use another method here, which is the linear approximation of the IRR. So basically, we need 2 points here. Let's randomly pick a discount rate that makes the NPV negative, okay? And let's call it R minus. And the NPV, or the minus NPV here, let's just call it NPV minus. And let's pick another discount rate, which makes the NPV positive. So R plus here is our discount rate, and the positive NPV, let's just call it NPV plus. So now we have 2 dots over here. Okay, so we know the relationship between the NPV and R is most likely a downward sloping curve, and it's not a straight line, but we can approximate this curve by forcing it to be a straight line. So basically, we're connecting these 2 dots, and whenever this straight line crosses the horizontal axis, that is our approximate IRR, while our real IRR is somewhere here. Somewhere here. So this is only approximation, and as long as the error or the discrepancies are not too obvious, then it's going to be a very good approximation. And the best thing is we don't need our Excel or a higher order polynomial to solve for this linear approximation. And it is calculated using this formula, which is R plus plus the NPV plus here, or the positive NPV, divided by the positive NPV minus the negative NPV. So be reminded, this number is going to be a negative number. And this thing multiplied by the R minus the R plus here. Okay, so this is going to be our approximate IRR using linear approximation, and it's going to be very easy to calculate. Okay, and then there are a bit of more caveats when you're using the IRR here. So our critical assumption here is that the relationship between the NPV and R is always strictly downward sloping. This only happens when you have negative cash flows happening before your positive cash flows. So you can have as many years for negative cash flows, but whenever it turns positive, it stays positive. Okay, so if you have negative cash flows in, let's say, year 1 or year 2, and then you have positive cash flows, and then again you have negative cash flows, so the cash flows sort of oscillates between the signs, then you may or may not have an IRR, and whenever you have an IRR, you might end up with multiple IRRs. So on a graph, sometimes the NPV could look like this, and then you have multiple IRRs here and here, or sometimes you don't even have an IRR. Okay, so it might look like this. Okay, so there's a bit of caveat when you're using IRR, and it's most useful when you have all your negative cash flows happening before your positive cash flows. Okay, so why do we use IRR, since it's not always going to work? So it's going to provide us with an easy benchmark for any of the projects or the assets we're trying to invest. So this is most useful when you're not very clear or very or you don't know about the actual discount rate for the project. So you can provide yourself with a benchmark. So whenever the real discount rate is higher than the IRR, we're not going to invest in that. And whenever the real discount rate is lower than the IRR, we can invest in this project, because the discount rate being lower than the IRR means this project is going to give us a positive NPV. Okay, so we'll see other investment appraisals methods in the future videos, and I'll see you there.